Has the stock market completely lost its mind? Around the world, economies are slowing, yet equity markets keep smashing new record highs week after week. Naturally, everyone's asking the same question: what's really going on here? That's why today, we're going to explore why markets keep rising no matter the headlines, why governments can't actually afford a recession, and most importantly, what all of this means for the markets. My name is Louis, and you're watching The Coin Bureau. Now, before we dive in though, I am not a financial advisor, and nothing in this video is financial advice. This is educational content meant to inform you about financial markets. So if that sounds good to you, make sure to smash that like button and let's get into it. Now, we've all been scratching our heads lately. Every time you turn on the news, the economic outlook looks shaky. The US economy is slowing, Europe's economy is stagnating, and China's economy is flirting with deflation. And yet, despite all of this, markets keep pushing higher. Macro analyst Jim Bianco sums up this reason as, quote, "Economic expansions don't die of old age, they are murdered." The point is that economies don't simply slip into a recession on their own. There's always a catalyst, some type of murder weapon that triggers a shift in behaviors across households, companies, and financial institutions. And if you look around today, there's no shortage of possible triggers. Trade wars, tariffs, rising geopolitical tensions, all of them could serve as the spark. But the markets seem unfazed. If anything, they appear bulletproof. So why is that? Well, to answer, we need to go back in time. You see, capital markets were originally created so companies could raise money by selling shares to investors, giving them the funding to grow. This isn't exactly the case today. Consider that the biggest net buyers of company shares today aren't investors at all. They're actually the companies themselves. According to the Fed's Z.1 financial accounts, in 2024 alone, corporations bought back 6 times more of their own stock than external investors did. The massive wave of buybacks has pushed valuations higher and higher, inflating market capitalizations and raising the question, what exactly are markets even for anymore? And it's not just buybacks that are warping things. Market concentration is more extreme than ever before. Most stock market gains are driven by a handful of companies. In turn, most of the market gains globally are coming from a handful of regions, mainly the US. The result is a kind of financial megastructure, a single interconnected system with capital, fear, optimism, and information flowing ceaselessly through it. And as with any complex structure, one crack in the foundation can shake the entire building. But before we get into that, we need to address another force that's been pushing the markets higher, and that is passive investing. Macro analyst Michael Green argues that markets today are being driven primarily by what he calls a, quote, "giant mindless robot of passive investing." Passive investing is a strategy that's exploded in popularity, largely because of tax incentives and pension structures like US 401k plans, which, for non-US viewers, are essentially retirement accounts that automatically funnel money into the market every single month. But here's the catch. This giant mindless robot isn't making rational decisions. Its algorithm is brutally simple. When cash comes in, it buys. And it buys stocks strictly in proportion to their market capitalization, with no consideration of whether those companies are actually undervalued, overvalued, or fundamentally risky. And this, ladies and gentlemen, is where the core problem lies. The price of stocks is no longer based on a fair assessment of value. It's just whatever the next passive buyer is willing to pay. Green argues that the system is essentially, quote, Ponzi-like in nature. Not only that, but it's a self-reinforcing loop. As more money flows in, the biggest stocks get rewarded, which drives their prices even higher. That, in turn, attracts more flows, which pushes them up even more. This is how tech companies like Nvidia and Apple have become so dominant. Every dollar flowing into passive funds disproportionately feeds the biggest names, making them bigger with every cycle. And this isn't just theory. Green's research found that for every dollar allocated to a passive fund, the total market cap can rise between $17 and $20. By comparison, an actively managed fund has a multiplier closer to just $2 of price impact. The result is that the S&P 500 is trading at valuations we've only ever seen at major peaks. But because passive flows are price insensitive, the momentum continues. And now those flows are broadening out. With crypto ETFs being approved left and right, passive capital is entering the digital asset space like never before, potentially pushing it into uncharted territory. And speaking of crypto, if you want to take advantage of this momentum, then make sure to check out the Coin Bureau Deals page. That's where you'll find exclusive sign-up bonuses worth up to $100,000, trading fee discounts of up to 50%, cashback offers as high as 75% on some of the top exchanges. And now that some allow tokenized stock trading, you can buy stocks and crypto all on one platform. Just hit the link in the description or scan the QR code on your screen. Once you're there, browse all the offers and click Sign Up Now to claim your deal. Now, remember, these deals won't last forever, so make sure you grab them while you can. Now, stock buybacks and passive investing aren't the only reasons why the markets keep on climbing. Another big factor is growth, or at least the appearance of it. Investors stay optimistic as long as the data shows expansion, because growth means earnings, and earnings drive markets. Problem is that today, most of this growth is being propped up by government spending rather than the private sector. Smaller businesses, which are vital to private sector growth, have been squeezed by tariffs, higher costs, and uncertainty. The result is that governments have stepped in to carry more of the load, particularly in places like Europe. There's just one problem. Government spending adds fuel to the economy, but it also upsets the bond market, because most of this spending is financed by borrowing. When deficits rise, investors start worrying whether the government can issue so much debt without straining demand, and whether inflation will erode the value of the bonds that they hold. Their response is simple: they sell bonds. That pushes bond yields higher, which slows the private economy and makes government borrowing even more expensive. More importantly, selling large amounts of bonds means that large amounts of money become due at later dates. This is a particularly big problem for private institutions, which face big debt refinancing walls that could further weaken the private sector economy. According to Michael Howell, a leading expert on global liquidity, institutions will face a large refinancing wall in 2026. That means rolling over massive amounts of debt at much higher interest rates, which will drain liquidity out of the markets. As of September of 2025, Howell's latest forecast suggests the current liquidity cycle could extend into early March 2026 before flattening out. That would likely mark a peak in risk assets, with commodities taking the lead. They're seen as a hedge against inflation, since they often move independently of stocks and bonds. And if you want to see the effect that liquidity has on crypto, well, we made a video about that right over here. So, we're left with a paradox. How can governments re-accelerate the economy through fiscal policy if every spending surge pushes bond yields up and discourages borrowing? One answer, ironically, is to let the markets crash. A sharp correction sparks a flight to safety. Yields drop, and only then can governments step in with another round of fiscal stimulus, just like what we saw at the start of the year. Now, one obvious way to reset the financial system would be a full-blown recession. After all, recessions, as painful as they are, serve an important purpose. They expose the weak points in the economy, force households and businesses to confront what's not working, and clear the ground for healthier growth in the future. But here's the problem. Governments simply can't afford recessions anymore. To understand why, let's start with the US. The federal deficit is already running around 7% of GDP, a level only seen in the modern times during the crises of 2008 and 2020. In other words, before a new downturn even begins, we're already starting from a historically extreme position. If a recession does arrive, however, those numbers would explode even higher. First, government spending always surges in a downturn. Since 2000, federal expenditure has jumped by an average of around 10% during recessions, thanks to unemployment benefits, stimulus, and jobs programs. With today's gross federal spending sitting around $7 trillion, that would take it closer to $8 trillion. At the same time, government revenues collapse. In fact, a significant portion of U.S. tax receipts come from financial markets and capital gains. So when stocks fall, tax revenues fall alongside with them, with federal receipts dropping by roughly 20% during recessions since the 2000s. And of course, GDP itself shrinks. GDP is the economy's balance sheet capacity to absorb new debt, and a smaller balance sheet means less room to borrow. Put it all together, and the maths gets ugly. If GDP falls and the deficit blows out of control, The deficit to GDP ratio could spike into double digits. At that point, you're staring straight at a debt crisis. And this is where things get really dangerous. Historically, during recessions, the Fed cuts interest rates and long-term bond yields fall. That's called a bull steepener. But that's not what's happening today. Since the start of the current rate-cutting cycle, we've seen a bear steepener instead, with long-term yields rising even as the Fed cuts short-term rates. The reason is simple. The bond market knows that if a recession hits, the government will be forced to issue an avalanche of new debt to cover its exploding deficit. But the market's capacity to absorb all that paper simply isn't there. That's why the Fed holds a massive share of Treasury debt, as without that backstop, the system could have cracked by now. So imagine what happens if a recession does land. Bond supply soars as the Treasury floods the market with new issuance, but demand dries up as investors retreat. That drives interest rates even higher, which makes the government's interest bill balloon, forcing them to borrow even more. A recession would essentially pull the rug out from under the entire financial system, triggering a spiral of higher rates, rising deficits, and ballooning debt. In the end, the Fed's only option would be unlimited money printing, what some call QE infinity, just to keep the whole system afloat. So, what does all of this actually mean for the markets? Well, the same forces that have pushed asset prices higher for years are now running into some serious headwinds. First is demographics. As we've discussed, the so-called mindless robot of passive investing relies on a constant stream of capital. For decades, that came from baby boomers adding to their retirement accounts. But now, many of those same boomers are reaching the age where mandatory withdrawals begin. Instead of adding money, they're taking it out, while fewer young people are entering the workforce to replace those contributions. Add in the rise of early retirements, and you've got a demographic headwind that slows passive flows and, by extension, the market itself. The second headwind is geopolitical. When the West froze Russia's foreign reserves in 2022 after its invasion of Ukraine, it sent a clear signal. Holding wealth in US dollar assets is no longer risk-free. Since then, more countries have started pulling capital back home and diversifying away from assets once considered untouchable, like US bonds, into alternative assets such as gold. And with the world becoming more polarized, that steady erosion eats away at the narrative of American exceptionalism that has underpinned US markets for decades. Then we've got liquidity. When liquidity expands, assets climb. But when it reverses, markets tend to stall or fall. And while governments will likely keep spending, the cost of this spending keeps rising as debt piles up and yields stay high. Finally, there's the stagflation threat. The Federal Reserve's two mandates are maximum employment and price stability. And right now, both are flashing red. Trump's tariff war risks reigniting inflation. And if that happens, the Fed could be forced to raise rates again or keep them higher for longer, even as unemployment ticks up. That's the stagflation nightmare: weak growth, sticky inflation, and corporate earnings, along with the markets that depend on them, getting crushed. So it's becoming increasingly clear that the mindless robot isn't all-powerful. The flows that have supported markets are running into limits. Demographics, debt, and deglobalization aren't going away. And the era where you could just buy the index and expect 10% returns every single year may already be behind us. One thing's for sure, though, and that is that governments will try to keep the system going for as long as possible. But like every other Ponzi, it only works until there are no new buyers left. And if you think that sounds bad, just wait until you hear about the demographic time bomb ticking underneath all of this, which we cover right over here. And if you haven't subscribed yet, well, you can do that right over here as well. Thank you so much for watching, and we'll see you again very soon. It's Lewis, signing off.